Welcome back, everybody, to another 21st Century Renaissance and another open interest newsletter breakdown with your host, me, Dr. Michael LoPiano. Wonderful to see you all. Welcome back. We have another interesting trading day coming up. Who would have thought? The last trading day of December, the last trading day of 2024, shaping up perhaps to be something more interesting than an ordinary Tuesday otherwise might be expected to produce, something like that. So today's topic is a bit of a twofold topic. I want to dive in, of course, as always, to the factors that I think are going to be most influential on our price action today and heading into the end of this trading week, as we try to make sense of what is really driving our price action on a day-to-day basis, intra-week, and then on a week-to-week basis additionally. We're going to spend some time with that, taking a look at our technicals, taking a look at our options data to see what we can see. However, I also want to continue to visit this topic of Ryan Cohen's recent tweets, recent posts on X, that is over the 2024 year. Yesterday's video, I was moved to go ahead and talk about one of his more recent tweets that had to do with the GameStop TA team, that is ostensibly the talent acquisition team, but posts which nonetheless seem to line up somewhat coincidentally, conspicuously well with certain key moments, key developments, let's say, in our technical analysis, in our technical landscape overall that has to do with GameStop trading. Now, again, this might be completely coincidence, but it is worth noting, it is worth paying attention to, especially insofar as Ryan Cohen, mere hours, I think even mere minutes after I posted yesterday's video, produced, yes, yet another TA team post on X, this time having to do with cellware, looking for a particularly experienced computer programmer. So we're going to dive into a little bit of that. I will entertain a little bit of speculation today, in part because it does help us think about what we might be seeing in the months ahead. This is, of course, much more difficult to forecast, to get a kind of ballpark idea about when we might see major turning points in price action, how that may relate to our fundamentals, especially as we are looking at a pretty long stretch before we might anticipate, before we are anticipating hearing anything in particular from the company itself. That is, as regards the fundamentals of the company. So let's hop into this today. I will start with talking about the latter of these topics. We will get a look here at what I have titled preliminarily here, GameStop to beat year-over-year revenue. Okay, now what could this possibly have to do with Ryan Cohen's most recent post? What entirely am I getting on after here? I suppose getting at something like that, getting on after. I don't think that's a thing that people say, but I said it. So I guess it's something people say now. At least it's a thing a person says. Okay, so, right. So we get this post today from Ryan Cohen. I commented a little bit on this preliminarily on my X page with a few just quick posts, a few quick quotes before developing this more thoroughly in the article for today. By the way, if you are joining us for the first time, I post regular full analytical articles to my X page every trading day. Some bonus articles sometimes on the weekends when I'm really feeling the spirit move me. You can find them, if you're viewing this on YouTube, linked at the bottom of the page, right in the description. If you are viewing this on X, then you need only go up to the top of the page. You'll find today's post pinned and past articles, of course, penned and stored in the articles tab on my page. Please do go ahead and give those a look. And yeah, let me know in the comments if you have any questions or if you have any feedback there. Deeply will be appreciated. So yeah, we're looking at Ryan Cohen here. Ryan Cohen comes out with a tweet. This one is perhaps the most conspicuously job search focused post that we have seen him make, right? I mean, how do you get TA out of this besides that little TA team thing there, right? Looking for software engineers in Dallas with 10 plus years experience in full stack React, Java, SFCC, headless, PWA, or mobile React native, intense and hands-on engineers only. Email tateam@gamestop.com. I have no doubt that there is probably some component of this that does have to do with a job search, right? Part of what makes the tweets that I find that Ryan Cohen makes probably what, well, obviously cryptic meanings are only speculative at this point, but one of the most masterful ways to encode symbolic information is to present that symbolic information in the context of something that is materially true. For example, in many cases, this is how one approaches certain mythological representations. This is how one approaches, say, the way that certain stories are represented in the Bible, right? In many cases with this genre of literature where one is attempting to encode behavioral or procedural information, perhaps psychological information, symbolically, one can do this by organizing something that is materially and structurally true in such a way that it simultaneously points to a symbolic meaning, right? So this is, I won't get too much into a theory of symbolic communication and symbolic meaning here. It is something I have spent a considerable amount of time thinking about in I suppose, a former life as a humanities instructor and researcher. But what really stuck out about this to me, cutting right to the meat of the matter, why I decided to take a closer look at this was that, again, right, nothing, a sort of not anything that likely had much meaning, but something that stuck out to me was that this post asked for somebody with 10 plus years of experience. Now, I happen to have in my bio, in my X bio, I mentioned that I have spent 10 plus years studying the Renaissance. Now, do I necessarily think that Ryan Cohen put out this tweet in order to get my attention? I think the odds of that are probably quite unlikely that this was a tweet that was written specifically to get my attention. But nonetheless, right, this expression, 10 plus years experience, is something that I have foremost on my bio, and therefore it's something that stood out to me. So I went around, I did some digging, I looked up some of this, I checked Superstonk, I checked through Twitter. There are a number of other people, I think, who have pointed out some of these degrees, so I can't take full credit for noticing every aspect of this. Certainly not, right, part of what makes GameStop such an interesting stock to research and invest in is that there is this distributed intelligence across many different social media platforms, across the internet, across so many different people, so many different individual investors, all undertaking their own research, taking inspiration and ideas, and then furthering that, such as to improve their own individual decisions as investors and traders. So I can't take full credit for the inspiration to go investigate some of this, but it turns out, right, that these processes, full stack React, right, so React Native, this was not online. This was not available until March 26th, 2015. So as of right now, it's impossible for there to be anyone alive who has 10 plus years of experience in React. At the same time, PWA, I forget exactly what this stands for. It has to do with applications, mobile applications. This concept, right, this term wasn't even developed until Google engineer Alex Russell published an article on the concept in which he coined the term on the 15th of June, 2015. So there isn't experience in these things that exist beyond 10 plus years. Okay, some people have been good to point out that this is kind of a meme when it comes to hiring computer programming, right? Job applications often ask for computer programmers, even the people who experience, let's say, experience repertoires which exceed the experience of even the people who designed the platforms, right? So, okay, there's something to that. I think I saw something by this guy, Thor, on YouTube, posting some kind of a short about that. But in any case, right, I went ahead and I looked at this particular date, right, 26th of March, 2015. But the 26th of March, right, 26th of March looks to be about exactly when GameStop would be publishing their year-over-year earnings, right? So quarter 4 and the total yearly annual earnings report for fiscal year 2024. Interestingly, okay. And simultaneously yesterday, we also got this post from Larry Chang talking about sort of expanding on the 6 phases of company development and turnaround that value investors look at when identifying, let's say, a blue chip company, right? A company that has come to maturity, that is on the full track of value maturity, something like that, capital investors. And so he outlines a particular case here in his tweet where he points to a company that says, well, okay, there are these companies that go through what he's called the sort of teenage or adolescent phase of development, where they get their company off the ground, right? They get their concept out there. There's ideas about, okay, can they get their balance sheet figured out? Can they return to profitability, something like that? But even after these factors have been witnessed and developed by the broader market, many investors, Wall Street, might still be waiting to see, okay, but is there this potential of revenue growth? Okay, it's working now, but is the company accurately priced based on where their revenue is now? Or is this a company that has the potential for year-over-year revenue growth? And if so, then there is a serious amount of untapped, undiscovered, let's say, deep value that is within the company that has yet to be priced into the underlying stock of that company in general. So it just so happens that GameStop is exactly this type of company, right? GameStop went through a period of difficulty, right? Proved a period of concept, needed to go into a transformation, entered into a period of intent to undergo that transformation, and has been spending, under Ryan Cohen's leadership, the past several years turning around the balance sheet, turning around the company such as to shore up the downside, to ensure that the company is out of deep water in terms of possible bankruptcy risk. Ryan Cohen, especially this year with the at-the-market offerings and with the strategic closure of unprofitable stores over the course of 2023 and 2024, has indeed brought GameStop to a position that the bear argument in terms of, this is a dying brick and mortar company, it's going to go bankrupt, it's going to die, right? The original short thesis back from 2019 and 2020, this idea that there's no way GameStop can survive, even if it raises money, it's just going to burn through this. It's going to die, so it deserves to be shorted into the ground, something like that, right? Ryan Cohen this year, 2024, especially with these at-the-market offerings. I know a lot of people did not like these, people hoping for MOAS, but what these at-the-market offerings did is ensure that that component of the bear thesis was completely put to rest. That is what occurred this year. That portion of the bear thesis is null. It's gone. It's done. But even with that said, we've only just started to see price discovery emerge in GameStop in the past few weeks. Okay, we saw something of an explosion of the price kind of when these at-the-market offerings were happening. We've seen a pretty impressive appreciation in the price in excess of about 50% since our bottoms that we saw in August and in September. But that being said, we're still not seeing GameStop perhaps reach these much higher price to book value valuations that we see on maybe some other types of companies that are involved in things like tech or e-commerce, especially, which supposedly is what the big transformation, the excitement about Ryan Cohen has been these past 4 years. Chewy is e-commerce, right? He adopted an Amazon model in order to offer excellent customer service through e-commerce for pets. That was his great success with Chewy. Much speculation and what certain signs have intimated in terms of what the shape of this transformation of GameStop would potentially be is, again, along this lines of e-commerce transformation. We definitely see some of that in these recent job advertisements that Ryan Cohen has been posting to his X page. But what about that actual direction for the transformation? Do we have a direct plan? Now, the bearish thesis at this part has now pivoted from it's a dying brick and mortar business to there's no reason for them to keep their retail business, something like that. We don't have guidance. Who is this? Michael Pachter for Wedbush, I think just prior to the release of the Q3 earnings report back on December 10th, came out and said something like this. There's really no reason why the stock should be trading at 2 or 3 times cash value, 2 times cash value. This is ridiculous. We don't have a direction for the company. We had people coming out back, in the summer, in June and July and August saying, oh, wow, GameStop. Well, it looks more like a bank stock with all this money that they're raising and not directly telling us what they're going to do with something like that, right? So these accusations that the company should just sell off. I directly saw somebody come out and say this, an analyst over the summer, say that GameStop should just close down its retail business and just become a bank, right? They would enjoy greater profitability off of the investment of that cash into treasuries. As opposed to whether they continued to sustain losses from their retail business. So the last seeming domino in the way of, let's say, value price discovery, this seems to be what Larry Chang is intimating here. The last domino in the way is, or I should say the last domino to fall, the last obstacle in the way is evidence of year-over-year revenue growth. Now, could it be that with this particular tweet, with this X post, these 2 X posts from 2 GameStop insiders, that there is something of an intimation, a suggestion, a symbolic encryption of the idea that year-over-year earnings growth is to be expected as far as is concerned in the annual report coming up on, say, March 26th? Who knows? We'll have to wait until March 26th to find out. Possibly, certainly 4 years ago, earnings in GameStop, right? The 2019 fiscal year earnings report, annual earnings report was released on March 26th of 2020. Shortly after this date, GameStop reversed to the upside off of its all-time lows, right? This was a major subversion of analyst estimates about the profitability of the company. It was over a 100% earnings beat in particular at that time. Now, that wasn't sustained, but GameStop has also continued to surprise through 3 quarters of 2024 with earnings beats, right? And is moving into the territory of overall profitability even before reaching GameStop's strongest quarter, which has historically been its Q4. In fact, many of our years over the past 10 years, many of GameStop's years over the past 10 years have been unprofitable until Q4 results come in and GameStop demonstrates incredible profitability, incredible returns from its year-end holiday sales. So is this something of that sort, right? Could we be getting that type of information? Who knows? Definitely check out the article if you want a step-by-step walkthrough of what I just broke down for you there. It's worth considering. It's worth taking a look at. And but there may be something else to this tweet, particularly as concerns my suggestions yesterday that perhaps these TA team posts also somehow cryptically line up with suggestions about important technical developments from the perspective of technical analysis. Now, obviously, I can't prove that the tweets have this sort of intention behind them. This may, of course, all be coincidence. This may also be the product of something like the broader market reacting to the fact that there's a tweet. But certainly interesting to consider the positioning of this tweet as in time, I should say, the choice to release this tweet yesterday, heading into today's potential price action, which, as I suggested, reveals that there is, in fact, a potential, an opportunity here for price action that carries us up toward our $35 resistance level, this big call wall overhead, and this, which lines up with the top resistance line of our overall bullish regression channel that we've been trading in for the past 2 months. So what I'd like to do is walk us through some of these data, some of these perspectives to demonstrate why I'm seeing this potential for this type of movement. I'm not necessarily saying that this is going to happen. I'm not saying, oh man, go bet all your money on this. Absolutely not. This is not financial advice. This is not trade advice. But I am going to lay out why I think there is a strong potential for this, and maybe what the sorts of signs, let's say, what would be the events necessary in order to see this scenario develop, and why I think it's something that's more likely and not, say, purely speculative or random, something like that. So let's get into it. First off, our price movement recap yesterday. We opened up off this shallow bounce. I think I mentioned yesterday, we had a decent chance of something of a small bounce, a shallow bounce off of the 24-hour moving average. We did indeed go ahead and touch that. So that is 3150 level here. If we zoom out a little bit, something like, see if I can share this instead. So if we take a look at our chart here, as we can see, pre-market yesterday, zoom in a little bit. We're over on the 4-hour chart here. Right, pre-market, we headed down, tested. So you probably can find this on the 1-hour a little closer. Right, headed down here, tested in the pre-market, actually traded a little bit below it. Right, traded below this. Oh, this is now the 1-hour chart, but we can still see it on the 4-hour chart. It's a little bit closer on the 4-hour chart, but right, pre-market, headed down here, traded just a little bit below, went down to 31.51, and then had a nice shallow reversal off of that, which kept us pretty much above the midline here of our bullish regression channel. Traded up to the resistance line of this more range-bound regression subchannel, as we saw, and then we kind of worked our way back down and traded all throughout pre-market and after hours on top of this as a support line, as something of a downside support technically. We're trading a little bit below that right now. Let's see. We'll have to see what develops. So what this looked like, right, we can see how closely we kept this kind of technical respect within pennies, right? Moving to within pennies of this as a support earlier in the day, right? Little overextension beyond that resistance line and trade back down. Little overextension beyond the support line and trade back up and back down, right? Use the 200-minute moving average, and then we kind of cool off, get some shorting, pushes us down below VWAP. Now we're trading in a VWAP / 200-minute moving average channel here that also is using the midline for support. Then maybe a little bit more shorting, trade down to VWAP support there, and trade back up into the close for close 1 cent above $32 and just below the VWAP line, the volume weighted average price. Obviously, pre-market today, we did trade up a little bit. Overall, a pretty bearish orientation on the day. A lot of short call trades. A lot of, with IV levels being this high, especially early in the week, short call trades especially far out of the money. Short call trades are particularly profitable. They lose value. They gain value very dynamically on an up move, especially early as IV spikes, since all of their value is extrinsic and highly dependent on the IV levels. So the Vega value of that contract is going to drastically apply a multiplier to the very small deltas on these out of the money contracts. This is the effect of Vanna. So delta change with respect to implied volatility, that is delta change per Vega. So what happens is you'll see really, really huge swings in the price of these out-of-the-money contracts. The $40 contract in particular yesterday was especially liquid, a high number of trades at this strike, and you were seeing things like 50 to 70% swings in this contract. So a very popular contract to trade yesterday. Obviously, trading long options puts you at a disadvantage versus trading short options. So shorting these $40 contracts was especially valuable and probably got some traders some nice returns yesterday. We can see that being reflected in our overall premium and balance, which was by percentage definitely skewed toward bearish sentiment, I should say. But okay, why am I talking about this potential for a 35 test? Well, part of this is based on this sort of periodization structure that we've been seeing on the 4-hour chart. So we can see that we've been through these two phases, each about a month long, 4 periods of trading within first the upper, then the lower channel, a smaller period right at the start of our bull trend back here, right? But sort of moving within this lower channel that sort of established the lower channel, moved into the upper channel. This is what these first sort of 3 peaks here are what has established our bullish uptrend, has given us a forward projecting technical paradigm for the past few months, right? Since the end of, basically since the first, let's say 2 weeks of November, because of this movement, right? Because of this movement that went at, what was this? 28? This is 28, 29. Yeah, we didn't quite reach 30. We didn't quite reach 29. So this first move up to 28, up from this trading in the lower part of the channel up through 25. This movement is what has established and kept the structure of that bullish regression channel for us. We traded in the upper portion of this paradigm, right? So upward test, downward support on the midline, upward test, downward support on the midline, right? But a little bit below it, using the 54-hour moving average as a support, but then back another upward test of the resistance line and back down, not quite reaching it. But then we'll overextend way over the resistance line, heavily over the resistance line, sending a lot of RSI signals across multiple layers. And then we come back down. But this time we break through on the tail end of some very, very heavy shorting, millions of shares dumped through key technical levels, through key options levels intraday. We short through the 54-hour moving average. We short through the midline of our bullish regression channel and head down to try to find support at the next nearest technical moving average, which is the 104-hour. And then, right, we sort of negotiated that. Roaring Kitty's tweet comes in. We had a great reaction to the Q3 earnings report. This is the only time we really kind of got down there was in that earnings after hour candle that moved us down to this historic kind of bottom here. Right, we dipped a little bit below $26, right? But then more periodization. So now trading in the lower channel, right? Support, resistance when we go above the midline, support below the resistance line, resistance above the midline of the bullish regression channel, support again at the support line of the bullish regression channel, and then resistance again when we move up above the midline, and then right immediately short back down, and then back to resistance again. Okay, so we had 3 more of these periodizations. And then this last time, after 1, 2, 3, the 4th one punched up through the resistance line, up through resistance at the midline of the channel, all the way to the resistance line of that bullish regression channel itself, which is 2.68 standard deviations above the midline, the mean closing price of our price action throughout the duration of this trend. So what we've done since then, right, is for 2 trading days heading into a third, we've more or less pretty quickly, anytime we've sunk below the midline of our regression channel, we pretty quickly, like within the span of certainly no more than 2 hours, but more likely 1, we pop back up over the midline. So that's been true for 2 full trading days, the after hours period and the pre-market period that we just looked at. Like I said, when I flipped over to our chart, we are trading a little bit below that right now. Maybe we head down to the midline of that bullish sub-regression, or yes, more range-bound, but still bullish sub-regression channel. Maybe we find support there. I think I also talked about today, we might seek out some support at the confluence of the 54-hour moving average when it intercepts the midline of this lower channel. That is a possibility. But right, we have been showing some willingness, at least over the past, or let's say unwillingness, to allow the price to trade much below the midline of our bullish regression channel. Right? Maybe we do. Maybe we really seriously head down there. But you know, it does look like maybe we find a support, and then the next move, based on how our periodizations have gone, is suggested that then we move back up for another test, at least into the middle of the upper regression channel here, maybe even try to push for a 35 test as the top line. Now, I've suggested through the way that I talk about dealers managing their positions, their options positions, obviously $35 is not a position that dealers would certainly like the price to take and hold at the end of the week. They would like that necessarily to, if it is tested, right? They don't mind those price levels being tested because it means that they can sell quite a lot of short calls, especially to, say, some less informed investors, less informed traders who have a tendency to be overly bullish, to trade disadvantaged instruments, right? Probability disadvantaged instruments like long calls, and therefore take in quite a lot of premium in profits. So, right, 75% of this, just a study last year published that 75%, this is just on SPY now, 75% of all options volume on SPY is 0 TDE long options. 75% of all options trade volume is 0 TDD, 0 days till expiry trading with long options exclusively on SPY. 75% of the options volume. Now, that same pattern tends to carry itself over into other popular retail stocks, GameStop being an incredibly popular retail stock that has a perma-high IV level. So options premiums, especially for out-of-the-money options, tend to be significantly higher, right? They tend to have extrinsic values in them that are significantly higher than similar stocks with lower IV values. What this means is that those contracts, especially when they're traded in short-term, right, in near-dated, when they're near-dated, okay, you can't trade 0 TDEs on GameStop except on Fridays, but okay, near dated stuff, if it's a week, if it's 2 weeks, because there is so much IV dependent extrinsic value on these contracts, there is a sizable amount of delta crush, let's say, that occurs very quickly on these as these contracts approach expiry. It happens in a very short period of time. Retail buying patterns tend to treat options like they are stock, which means when they start to take losses from some of these depreciative factors, they say, okay, well, only if it can get back to the price. Like, I'll hold this. If I just hold this, I have time, right? Like on shares, you're like, well, I can hold this. And if I hold this and I still believe in the fundamental thesis, then I can get my value back, right? If it gets back to where it was, right? Something like that, right? Loss taking, not something that's hard to learn, something that lesser experienced traders do not necessarily know how to do. They trade long options like it's long stock and inevitably end up trapped in these situations where they are forced to eat very large losses or have the complete value of their position in these highly leveraged, mostly extrinsic value laden long options contracts lose. Especially now that GameStop is in a bull trend, there's a lot of euphoria, there's a lot of positive emotion, there's a lot of implicit bias toward bullishness, especially on the part of retail. This is something that options market makers realize. This is something that dealers realize, and something they are only too happy to take advantage of by supplying way out of the money strikes in the options chain, so that when the price, say, approaches something like a call wall, retail traders, less informed options traders, even some experienced traders who don't know how market maker exposure, gamma and delta exposure, especially gamma exposure, is structured don't necessarily know that not all areas, not all sections of the map, not all price brackets are equal, and that the market maker hedging characteristics change as we move between strikes, as we move between different price valuation areas, sections of the map throughout the trading day. They change character as we move between those zones, and those zones themselves change dynamically throughout the day. So many retail traders don't realize this. They think, oh, well, if it really quickly went up to 35, why wouldn't it so really quickly go to 36 or 37 or 38 or 40 or something like that? Why wouldn't it do that? The answer is, well, because market maker hedging will prevent it from doing that based on how traders, institutions have positioned themselves in the options market with respect to that $35 price level. So as I was saying, as we head into the end of this week, I think there is possibility that we see something, especially because we've hung out in the middle of this $30 to $35 price bracket for a while. There is a chance that we see the upper end of this channel tested. This could still be something that dealers would take advantage of. If it happens earlier in the week, then there will be a bit more extrinsic value that can be packaged into these out-of-the-money options contracts, and plenty of time to potentially allow the stock to send reversal signals. If it happens quickly, the price reversal to the downside, there'll be more signals technically and in the options data that would suggest, ooh, go back to the downside, right? IV spikes, dealers, traders will go, ooh, time for me to sell, right? More experienced traders go, time for me to sell the positions I already have, or time for me to take short positions since this IV spiked really quickly. I know maybe it's going to come down quickly as well. I can sell to DTE, I can sell these. I have this opportunity. I can sell these, say, to GameStop's designated market maker, Wolverine Trading, right? They're going to be only too happy to do this, right? They offer certain rates. They're happy to take, 90% of retail trades that fail. They can afford to take, offer a few losing trades to more experienced traders. And then, traders can profit from that. However, that allows them to then switch the direction of their hedging such that it starts to move to the downside, picks up some momentum, and then moves back down to a place within the underlying price range that is more beneficial to their maximum profitability point with respect to their strategy as dealers. So we do have an opportunity here, right, technically to kind of move to the upside here. Might not happen today, could happen Thursday, something like that. It is in place. And I'll point out why. Right. So yes, just moving through this section at a bit of a quicker clip. You can go check out the article and take a peek at this. Right. We do see Max Payne hanging out at 30. Right. We have our highest put strike moving up to 30. So I mean, certainly the options, the open interest for this week doesn't suggest that we would move below 30. Doesn't project any kind of major price collapse, continues to affirm our trading within this 30 to 35 bracket. But what continues to offer the biggest support in this, the support to this continued stable trading within 30 to 35 is, of course, our market maker gamma exposure data. And that is that we have two very large positions of call gamma exposure at $30 and $35. What this means is that market makers are, together with Max Payne, not incentivized necessarily to take interventive measures to move the price below $30. There are a lot of calls that are going to hedge the rate of change in delta as we approach 30 to make pushing the price through that $30 level particularly expensive, right? You would have to devote a lot of capital resources to counter the antipathetic market maker hedging that is situated around that strike. So as that strike is approached, it acts as a very, very highly valent, a very strong downside volatility suppressant. The opposite of is true of 35. So as 35 is approached, it also acts as a highly volatility suppressant level, but from the downside, right? So the reason for that is because with gamma hedging, gamma values tend to peak. So the change in an options contract's delta peaks, has its highest values when the strike is about to go in, when that contract is about to go in or out of the money, right? So as you approach the strike, it's from farther away, right? Your gamma values increase quite markedly until the contract goes in the money, and then the gamma values start to decrease, right? So gamma hedging increases in strength as you approach it and decreases in strength as you move away from it. Okay, so that can be true if you're approaching from above or if you're approaching from below. If you're approaching from above, right, your gamma values are also going to increase. The rate of change of delta is going to see its most profound increases as you approach a given strike. So when you have a high accumulation of call gamma exposure, meaning a high accumulation of call options at a particular strike, dealers are going to engage in a particularly high volume of long share hedging, right? Since dealers are typically mostly short calls because retail is mostly long calls, it means that they will need to buy shares to gamma hedge their short options positions. Okay, so as that, right, you might say, okay, well, delta decreases, yes, but gamma increases as you approach those positions, regardless of the direction that you approach them from. So we have these as bookends within our range. We still have $32 and $33 as our most likely sort of candidate for a pin within the middle of this range, right? We have pretty sizable gamma accumulations at $32 and $33. What's interesting is we have 34 emerging as well as a decent call gamma exposure accumulation position, which acts as something of a bridge, as right, it stabilizes this area. It prevents it from being something of a hedging dead zone. It removes this as a candidate for a potential reversal in the options market, and enables more steady bullish trading up from, say, if we trade up above $32 into 33, if we do get some potentially heavy bullish options flow or some sort of external buying that pushes us up through 33, we could see trading kind of grind us up towards 35 to set up something like a deflection down to the downside. I think this would be a bit more of a candidate for something of a gamma ramp if options buyers do fill in some of these strikes to make some of those transitions a bit smoother. But there is potential for us to stably move up that way if the bullish will is there. Now, at the same time, I also pointed this out in the article. If we come out and bears decide, okay, let's push through that $32 position into this area, the 30.50 to 31.50 area, there is a lot less net call gamma accumulation in this area, so the price will be a bit slippery. Certainly, if we do move in terms of independent of technicals, it's less expensive in terms of the money you'd have to commit to move the price around more quickly and profit off of some value capture in this range. It would set up something like if we push all the way down to 30, which would require some pretty sizable technical collapse. We'd have to move basically all the way down to the 104-hour moving average. That would be a bit of a ways to go. I guess not. I guess not crazy, not impossible. But we'd probably have a hang up there first at around 30.80, 30.75. Like if we just fell right through the floor right now, we just fell through there, hundreds and hundreds of thousands of short volume, bearish options contracts, kind of momentum piling on that. We'd probably have a hang up first at 3081, 3080, like I said, 3075, that 54-hour moving average, and then kind of bounce back up before, again, if somehow bears are out there, if somebody's out there, wants to push the price down, wants to make sure we move back into this lower channel, goes and does, I don't know, a huge ETF creation order or something like that, creates some shares, right? Some new shortable shares, and then forces that. Certainly possible. I would see that. I would see that first. I don't see that as a high likelihood occurrence right now, but we'll have to see what develops. I would not see the price moving below $30 certainly before the end of this week. That would take some really determined bearishness, and we're not really seeing. I'm not seeing any factors, right, that would, not technically and not in the options market, that would suggest that there is organic sentiment there right now that would look to take advantage of a downside move, or would suspect a downside move to carry us below $30 at this point. That's my orientation toward that at the moment. So yeah, so what does that mean for us? I mean, do we end up testing $35 this week? I think there certainly is a chance for that. If we do get some call gamma filling in, I think, at those upper strikes. So we did see some new OI hop in at 33, right? 33 is emerging as an interesting level. Right, maybe some of that is through short call trades, although it does look like it's a mix of short and long volume at, I should say, well, volume certainly. I can't say what in particular is new OI. That's not really discernible from the order flow data. You can see ask and bid volume, but not necessarily what new contracts were at the bid, what new contracts were at the ask. So when you see it's 50% at the ask, 50% at the bid, it's kind of difficult to to say, oh well, this is all new short OI, or this is all new long OI. It's hard to say necessarily. So assuming a mix, but right, as call gamma can fill in these upper ranges, what it can mean is that the right flow of bullish options volume at the right level within that bracket can accelerate, can very quickly give an appreciation to gamma values all up this kind of chain, right? So as traders go out and buy long calls or sell short puts, the market maker must go out and hedge those positions by purchasing long shares. That is typically what we see moving the price. Most of those little price movements and kind of the broad trends of intraday price movements, barring, say, somebody coming and saying like, okay, I'm going to throw 200,000 shares of short volume onto the stock in 2 minutes, right? Something like that. Usually, what is pushing around the price on a day-to-day basis is market maker hedging activity. So when you go out, right, when a trader goes out and buys a long call or sells a short put, the market maker must go out and hedge that position, that new OI, that new long call OI or that short put OI, by buying shares in order to stay delta neutral, right? So putting long shares on your books allows you to cancel the negative delta of being the counterparty to a long call that is holding a short call, or to a short put, which is holding a long put on your books, right? So the dealers want to make money by just kind of collecting premium from this extrinsic value. They want to see all of these contracts, the greatest number of contracts, expire out of the money. Their profitability model is on volume, and brokerage is on fees, right? So, but the market maker themselves, right, say Wolverine Trading is trying to make money off of just volume of contracts. So the more contracts that are purchased, the more money they make, independent of, say, the directionality or the sentiment behind those contracts. So as a long call or as a short put is purchased or sold, the dealer has to go out and buy shares. Now, as the dealer goes out and buys shares to hedge that position, it's going to push the price up, since they must go out into the lit market and buy those shares at the ask. It's going to push the price up. As the price pushes up, if that is taking place, say at the bottom of a particularly high gamma accumulation range, like we just saw, right, like we have here in our gamma data, our gamma exposure data, what we're going to see, what can happen is that this causes an appreciation of the gamma levels on these calls, on their short calls, but traders long calls. What then occurs is that because the gamma increases, right, the rate of change in delta increases by their own purchasing of shares to hedge new long calls or short puts, they must then hedge additional shares to account for the appreciated gamma values of contracts that are already existing. So when you have a lot of call gamma on the board and the gamma values of those contracts maybe have settled or are lower than they might otherwise be by being a certain distance in price of the underlying away from those, right, where our price position is, those contracts can cause, by their gamma value appreciation, sympathetic gamma hedging on the part of market makers that then causes the price to go up, that might then encourage traders to go and purchase more calls or sell more puts, and then move that, which causes the dealers to go and hedge more deltas, which pushes the gamma values higher than the money calls, right, which goes and goes and goes. And this can cause a gamma ramp or a gamma squeeze phenomenon, right? So any type of phenomenon like that that would occur would have to occur, right? You know, it's bound by what we see here by this bracket. So if we move to the bottom of this, right, we kind of hang out around 31.35, 31.50, and we get a decent volume, a decent inflow of bullish options volume, either via long calls or short puts or a combination of the two. It can cause something like a gamma ramp, a gamma squeeze to go off, where the price gets all of this very quick, very rapid market maker gamma hedging, pushing the price up in sympathy with that options flow sentiment. Now, I'm not necessarily saying that that's going to happen, but we are starting to see the development, right? The development of, we look at these positions, 32, 33, 34. If we move into this range, we stay here or we move into this range, right? We can take advantage, I should say, traders can take advantage. I'm actually taking, I'm moving the pieces around the board. Traders, the broader market, could potentially see an appreciation of trades that they would make to this extent, see an appreciation in the underlying that reflects this gamma hedging reality. Of course, when you smack into $35, right, when the price gets up there to 35, what do we have on the other side of 35? Not a lot of accumulated call gamma, so we immediately go into a hedging dead zone. We get a ton of antipathetic hedging, right? Then it's gamma values, right? So the gamma values go up as it's approach, right? When you get to it, it goes in the money, and then then they start to go down, and so then reversal trade, right? Reversal trade back the other way, because now you can profit off of the negative gamma accumulations, right? The decrease in gamma as you go back the other way, right? Traders can then sell calls and take advantage of the gamma and delta depreciation as the price then goes back down. And so that's how these types of momentum trades get set up. These big swings, say, in the price, the sort of which we saw yesterday, right, between 32 and 33, and why that served as kind of this ping pong bracket in the middle of our trading range yesterday for the early part of the day. So yeah, that's what I see developing here. If we get some more call gamma accumulating in that 33.50, 34, 34.50, we might see institutions attempt to buy in a high enough volume, right? No individual retail investor is going to be able to set something like this off. It's going to be an institution that has the capital to commit, that says, I can take advantage of this by stimulating in the market this way, by moving the market this way. So I'm going to pull the trigger and take my chances and figure out how to profit, off of an exit through there, maybe stimulate, right? The idea is then retail rushes in, provides exit liquidity, and then the institution profits. Something like that could could happen. We do have this kind of 35 test set up technically, not necessarily that it's going to happen, but right, okay, then winding kind of all the way back to the beginning. Then of course, there's always this recent post from the TA team and Ryan Cohen. Could this be another signal that we find support at this midline? Could this be another coincidental alignment of a post by GameStop CEO Ryan Cohen and a key technical level that precedes a major upward price movement, something like that? Who knows? Probably couldn't even if it did, right, wouldn't be able to necessarily trace or connect the two of those factors together, but something worth considering, something worth keeping in mind. So both this potential for a down trace into maybe the upper 30s, 31 again, something like that is possible. But regardless of whether that happens or not, something of an interesting move to the upside, possibly a test of 35, given our current options landscape, and of course, barring any externalities, barring anything, certainly some sort of bearish information about the company that might come out, or the creation of a huge number of new shortable shares that then get kind of dumped on the price, something like that. So yeah, so that's it for today. Thank you, of course, everyone, once again for watching and listening. A reminder that tomorrow the market is closed, so there will be no newsletter for tomorrow. There'll be no breakdown for tomorrow, since there will be no newsletter to break down. But good luck out there. Good luck with your trades. Good luck out there with your investment decisions. Thank you so much again for your support this year. Thank you to everyone who's gone out of their way to support my research here, support my publications, to encourage me, especially amid my deplatforming from Reddit earlier this month. It's been really great to have your support this year. A very warm, happy new year to everyone as we head into our first options expiry of 2025. So thank you very much once again. We'll see you guys next time. Take care.